The 37 Bank Private Ledger. 37 European banks have effectively formed a private central bank for digital euros to stop the digital dollarization of their continent. This month, the Qivalis consortium expanded from 12 members to 37, spanning 15 countries and trillions in combined assets. This is not a retail app or a speculative token experiment. It is a structural attempt to reclaim the settlement layer from US dollar stablecoins that currently dominate over 80% of global on-chain liquidity. By building a shared rail under the European MiCA framework, these institutions are preparing to move wholesale trade and treasury operations onto a single ledger they collectively control. Engineering the MiCA standard. From a design perspective, Qivalis functions as an electronic money token, or EMT. Unlike decentralized stablecoins that rely on algorithmic balance or volatile collateral, this protocol uses a full reserve model. Every digital euro is backed one-to-one by fiat deposits and high-quality liquid assets held in regulated custody. The engineering goal here is regulatory arbitrage. Because Qivalis is pursuing an electronic money institution license from the Dutch Central Bank, it will have a legal passport to operate across the entire European Union. This creates a compliance moat that offshore issuers cannot easily cross, effectively forcing institutional players into the Qivalis ecosystem if they want to remain within the legal perimeter of the Eurozone. Dissecting the liquidity rails. The technical backbone of this project relies on Fireblock's infrastructure to manage tokenization and treasury workflows. The real economic target is the correspondent banking fee pool. In the current system, a cross-border payment between a Spanish bank and a Finnish bank might hop through multiple intermediaries, taking days to settle and racking up fees at every stop. Qivalis collapses this chain into a single settlement event on a shared ledger. By using a common token, Bank A sends value to Bank B in near real time with finality. For the 37 banks inside the consortium, this is a bid to capture the economics of money movement that they currently lose to third-party clearinghouses. The mechanism turns the participating banks into the validators of their own payment network, bypassing the friction of legacy SWIFT architecture entirely. However, the reliance on a single third-party infrastructure provider like Fireblocks creates a central point of technical failure that the consortium will need to address before their planned launch later this year. The silent interoperability trade-off. A critical detail remains undisclosed. Will Qivalis launch on a public ledger or remain a permissioned walled garden? Choosing a public network like Ethereum or a Layer 2 would allow for interoperability with the growing market for tokenized bonds and real-world assets. However, a private model offers the banks total control over data privacy and transaction censorship. This design choice determines whether Qivalis becomes a foundational building block for global decentralized finance or simply a faster version of the internal banking systems we already have. The signal under the noise. The aggressive expansion of Qivalis suggests that the battle for on-chain dominance is no longer about which token has the best marketing, but which one has the deepest institutional distribution. This project represents a strategic pivot where banks are no longer fighting blockchain technology, but are instead using it to protect sovereign currency interests against the gravitational pull of the digital dollar. If successful, Qivalis could fundamentally change corporate treasury management by making the euro the default settlement leg for European tokenized assets, effectively neutralizing the advantage currently held by dollar-backed issuers. For developers and analysts, the primary metric of success won't be retail volume, but the speed at which these 37 banks activate their existing corporate client bases on the new rails. This marks the end of the era where stablecoins were merely trading collateral, and the beginning of their role as the primary plumbing for global trade. Watch for the official licensing decision from the Dutch Central Bank in the third quarter of 2026, as any regulatory delay could give competing dollar-based protocols more time to harden their grip on European capital markets. Subscribe for more